Something snapped on Wall Street overnight, and it showed up on the close. Walmart, Intuit, Nvidia, Salesforce, Sherwin-Williams, 5 names with nothing obviously in common got hit in the same overnight window on May 21st. There is one decision threading every chart on the screen, and it was made months ago in plain sight. The entire tape from Thursday was not random. The setup looked perfect. The S&P 500 had spent 3 days clawing back into the green. Treasury yields softened. Oil was the only thing creeping higher. Traders had positioned for a soft landing, an AI supercycle, and a consumer that just keeps spending. Then the closing bell rang on May 20th, the after-hours wires lit up, and by the time New York opened on Thursday, every single one of those assumptions was bleeding on the tape. Let's start with the size of the move. The S&P 500 dropped 0.5%. The Nasdaq 100 lost 0.7. The Dow shed 0.5% too. That doesn't sound apocalyptic until you look under the hood. Walmart alone was down more than 6%. Intuit, a sleepy software giant most people don't even watch, had been gutted by double digits in extended trading. The damage wasn't broad. It was surgical. This is the part where the index hides the carnage. When the headline number falls less than 1% but 5 of the most followed tickers lose multiples of that, what you're really watching is a positioning reset. The market isn't selling everything. It's selling conviction. And the names being hit are the exact names that every long-only fund in America was overweight going into earnings week. That is what makes this snap dangerous. To understand what Wall Street missed, you have to understand what Wall Street was watching. Heading into Wednesday night, the entire desk had one trade. Long AI. Long the consumer. Short volatility. The thesis was simple. Nvidia would beat. Walmart would reassure. The Fed would stay on the sidelines. Intuit, Salesforce, Sherwin-Williams, these were supposed to be the boring compounders that quietly grind higher while everyone obsesses over chips. Analysts were bullish on every one of them. According to the Street's late Wednesday recap, the consensus was that Nvidia could push toward a $6 trillion market cap. Walmart was supposed to confirm that Americans were still spending. The Street had set the bar high, and they had set it across every sector at the same time. That is the trap. The higher you set the bar, the more an average result feels like a miss, and the average result is exactly what arrived. Nvidia reported sales of $81.6 billion, up 85% year over year. CEO Jensen Huang told the call, quote, "Demand has gone parabolic," end quote. The company announced an $80 billion buyback. By any normal standard, that is a blowout. But Capital.com analyst Kyle Rada called it, quote, "a garden variety beat," end quote. The market agreed. The stock closed down 1.8%, but it gets worse, because the Nvidia print was supposed to be the catalyst that pulled the rest of tech up with it. Instead, it became the alibi. When the strongest beat of earnings season can't move the stock, every other name loses its excuse. Salesforce dropped 4.27%. Bank of America's Tal Liani had already cut his price target to $160 with an underperform rating 2 days earlier. Now that call looked prescient, and the bear thesis underneath Salesforce is the part that should freeze every software investor watching this. The fear isn't that Salesforce is a bad company. The fear is that AI agents are starting to replace the seats that Salesforce charges for. If your customer needs 10 logins instead of 100, the SaaS pricing model breaks. That fear sat under the entire software complex on Thursday, and it was contagious. Now let's walk the 5 names that actually snapped. Stock 1, Walmart. The retail king reported total revenue of $179.5 billion, up 5.8%. Adjusted EPS came in at 62 cents, ahead of estimates. Same-store sales rose 4.5%. On paper, it was a clean beat. The stock fell 6.8% intraday. The reason was the guide. Wall Street wanted 75 cents next quarter. Walmart said 72 to 74. That sounds tiny. It isn't. When Walmart guides below the Street, the message isn't about Walmart. It's about the American consumer. Walmart's own commentary admitted shoppers are trading down. Revenue is coming from groceries and household essentials, not discretionary categories. People are still walking in the door, they just aren't buying anything they don't have to. With oil prices climbing and inflation sticky, that is not a soft landing signal. That is a slow squeeze. Stock 2, Intuit. This is the one that shocked the desk. After Wednesday's close, Intuit announced it was cutting roughly 3,000 jobs. 17% of its 18,000-person workforce. CEO Sazen Goodarzi sent a staff memo blaming organizational complexity and pointing every freed-up dollar straight at artificial intelligence. The stock dropped 3.95% in the regular session, then another 13.4% after hours. Intuit is now down more than 40% in 2026. Here's where it gets really interesting. Intuit is profitable. It is not a struggling company. It is laying off 17% of its staff because it believes AI lets it do more with less. When a profitable software company chooses restructuring over expansion, the signal to every other CFO in the index is permission. Permission to cut. And that permission is what changes the labor market story Wall Street has been pricing in all year. Stock 3, Nvidia. We already covered the numbers, but the price action deserves a second look. 85% revenue growth. Net income of $58.3 billion, well above the $42.9 billion analysts modeled. An $80 billion buyback. A dividend raise. Jensen Huang calling agentic AI, quote, arrived, end quote. And the stock still closed down. When a print that good is treated like a miss, you're not watching a stock. You're watching sentiment. Stock 4, Salesforce. Down 4.27%, hammered ahead of its own May 27 earnings. Stock 5, Sherwin-Williams. Down 2.2% on the day, hitting a 52-week low at $301.46. Sherwin is the housing tell. Mixed Q1 results, lowered full-year guidance, softer housing market, higher input costs. When the paint company can't raise prices and can't sell more cans, the renovation cycle is rolling over. So what did Wall Street miss? The 5 names look unrelated. Retail. Software. Chips. Cloud. Paint. But there is one decision threading every chart on the screen, and it was made months ago, in front of the entire market, and almost nobody priced it correctly. The decision was this. Corporate America decided to bet the next 2 years on AI, and to pay for that bet by squeezing labor and squeezing the consumer at the same time. Look at the evidence. Intuit fires 3,000 people and reroutes the savings to AI. Salesforce sells AI agents that compress the seat count its own pricing model depends on. Nvidia is the picks and shovels beneficiary of every one of those decisions, which is why even a parabolic quarter wasn't enough, the street had already front-run it. And the consumer paying for the squeeze? That's Walmart. That's Sherwin-Williams. 2 different windows into the same wallet. Wait until you see what happened next. While the 5 stocks were cracking, the Russell 2000 actually rose on a, quote, bogus report, end quote, that the United States and Iran were close to a draft resolution. The small cap rally on fake geopolitical news, while the megacaps got sold on real earnings, tells you exactly where the smart money is positioning. Out of crowded longs. Into anything that looks oversold and uncorrelated. This is the rotation Wall Street kept dismissing as noise. It isn't noise. It is the slow unwinding of the most consensus trade in finance, long the AI complex, long the resilient consumer, being repriced for a world where the AI capex is real, the consumer is fading, and the labor market is about to feel it. The 5 snap stocks aren't 5 separate stories. They are 5 symptoms of the same trade. Now you can see what that one decision was. Corporate America chose AI over headcount, and Wall Street modeled the upside without modeling the second-order downside. The downside is what hit the tape between Wednesday night and Thursday afternoon: slower consumer, compressed software seats, an Nvidia beat that pulled forward every dollar of good news. The snap wasn't 5 companies missing. It was the market catching up to a decision already made. So here's the question I want you to sit with. If a profitable company like Intuit is firing 17% of its workforce to fund AI, and the consumer is already trading down at Walmart, what does the labor market look like by the time we get to the next earnings season? Are we watching a one-day snap, or the first crack in the trade everyone was holding? Tell me in the comments. If this resonated, give it a like so the algorithm spreads it. Subscribe so you don't miss the next one.